Thank you. I now call on Kenneth Gibson to speak on behalf of the Finance Committee. Mr Gibson, you have 10 minutes.
Thank you, Presiding Officer. It is with pleasure I speak on behalf of the Finance Committee in this Stage 1 debate on the Budget Bill for 2016-17 and to our draft budget report published last Friday. Scrutiny of the draft budget always works to a tight and demanding schedule. This year's timetable was even more challenging than usual, as the Scottish Government had to await publication of the UK Government Spending Review in late November before introducing its own budgetary proposals. I would like to thank all those who contributed to our scrutiny, particularly given these challenging circumstances. As most members are aware, we approach budget scrutiny on the basis of 4 principles: affordability, the wider picture of revenue and expenditure and whether they are appropriately balanced; prioritisation, a coherent and justifiable division between sectors and programmes; value for money, the extent to which public bodies spend their allocations well in achieving outcomes; and budget processes, integration between public service planning, performance and financial management. This year we concentrated our scrutiny on affordability and budget processes. Historically, budget scrutiny focused almost entirely on government spending plans with little consideration of taxation. However, the devolution of some tax powers and the expectation of more to come fundamentally changes this process and caused us to reassess it. We considered the land and buildings transaction tax and landfill tax in detail last year, and this year a key element of our scrutiny has been on the Scottish rate of income tax. Subject committees considered government spending plans in their areas, and we recommended they examine the extent to which public bodies are adopting a priority-based budgeting approach to deliver those outcomes set out in the National Performance Framework. The committee welcomes the work of subject committees in making the shift towards a more outcomes-based approach. I thank them for their helpful contribution to our scrutiny process. To enable us to hit the ground running when the draft budget was published, we issued separate calls for written evidence in addition to taxation on the work of the Scottish Futures Trust and progress in delivering preventative spending. I thank all who submitted evidence. Given the new tax powers, for the first time we questioned the Deputy First Minister over 2 sessions. The first considered government tax proposals in detail before we scrutinised its spending proposals at an external meeting in Pitlochry. This worked well, and we will consider the need for further changes to budget scrutiny as part of our legacy report. In Pitlochry, we also held workshops with representatives of local businesses, voluntary organisations and public bodies, hearing first-hand about the impact of public spending on their community and how spending should be prioritised. Key issues raised included flood prevention, access to high-speed broadband, transport, housing and community empowerment. Nevertheless, given the topicality and importance of issues relating to taxation, I intend to largely concentrate on these, although I will also briefly touch upon the work of the Scottish Futures Trust and on delivering prevention. Other members will wish to discuss the government spending priorities, and I look forward to hearing from them. Turning firstly to affordability, the committee considered the need for a balanced budget with expenditure no greater than revenue. The draft budget proposes to apply a 10p rate of Scottish rate of income tax, meaning Scottish taxpayers will continue to pay the same rate of income tax as those in the rest of the UK. To inform our consideration of this issue, we held several oral evidence sessions in the autumn. 1 or 2 witnesses favoured a reduced rate of SRIT on the basis that this would act as a stimulus to the wider economy, boosting jobs and growth. Others advocated an increased rate on the basis that higher revenues could be used to reduce inequalities. However, a clear majority of responses supported the maintenance of the 10p rate for 2016-17, citing factors such as complexity for employers, mobility of labour, the economy's ongoing but incomplete recovery from recession, impact on a workforce that has endured below-inflation pay rises in recent years, and the blunt nature of the power. Having considered the matter in detail in our report, the committee unanimously supported the Government's proposal to set SRIT at 10p for 2016-17. Nevertheless, we heard some innovative proposals for changes to taxation going forward and recommended a wide-ranging debate across Scotland on taxation policy in anticipation of expected new financial powers from April 2017. To inform such a debate, one of our key recommendations is that future decisions on taxation policy must be informed by behavioural analysis. Expert witnesses explained how taxpayers could be expected to change their behaviour in response to tax changes. Evidence from around the world suggests that higher rates of income tax are likely to lead to behaviours that impact negatively on tax revenues, including reductions in labour supply, tax avoidance and migration. These behavioural responses are particularly important in relation to high earners, who are more likely to have the means, mobility and motivation to change their behaviour in response to tax changes. Professor David Bell told us that the highest 10% of taxpayers pay more than half of income tax revenues, while the top 1% contributes around a fifth. He estimated around 11,000 additional rate taxpayers in Scotland. As such a large proportion of tax revenue depends on a relatively small number of taxpayers, the committee was clear it is imperative that the potential impact behavioural response on tax revenues is assessed before changes to taxation policy are made. Ultimately, the intention underlying of the devolution of tax powers is that this Parliament will be responsible for raising more of the money it spends and thus be more accountable to the electorate. Nevertheless, a large part of its income will continue to be dependent on the block grant, and as members know, the mechanism by which it will reduce to compensate for devolved tax powers is of supreme importance to Scotland's future financial well-being. We have consistently raised concerns about the impact of relative population growth on the indexation of the block grant adjustment. We therefore welcome the fact that the Deputy First Minister supports the index deduction per capita method, and we recommend that this method is agreed in the fiscal framework which will underpin the devolution settlement. Members will not need reminding that time is of the essence in agreeing the framework if Parliament is to scrutinise it prior to dissolution. We look forward to questioning the Deputy First Minister and Chief Secretary to the Treasury on the framework in the coming weeks to consider if it meets criteria agreed by the Smith Commission and, importantly, is fair to Scotland, the rest of the UK and meets the no detriment principle. The Finance Committee has consistently raised concerns about the lack of transparency in relation to block grant adjustments arising from the devolution of financial powers, and we believe that full transparency is an essential element in securing public confidence in the process. It is therefore imperative that the fiscal framework contains detailed explanations of how the block grant will be adjusted in 2016-17 and beyond. Regarding taxes already devolved, we have closely followed developments in the first year of their operation, particularly regarding land and buildings transaction tax. Stakeholders raised concerns that LBTT had a negative effect on sales at the higher end of the property market. Whilst it is not possible to fully assess LBTT's impact before outturn figures for the full year are available, latest indications are that high-value sales are returning to previous levels, whilst according to your move, Akadata, the middle and lower tiers of the market have been given a new lease of life by the government's approach. On this basis, we are supportive of the proposal to maintain the current rates and bans for residential LBTT. However, we also recommend that the Government conducts and publishes a review of LBTT once outturn figures for its first year of operation become available. This will doubtless assist Parliament in its scrutiny of next year's draft budget proposals regarding LBTT. Members will be aware that the committee takes a keen interest in the Scottish Fiscal Commission's work. Indeed, Stage 2 proceedings on the bill, which puts the Commission on a statutory basis, take place next week. I look forward to discussing issues raised in our Stage 1 report then, and therefore do not intend to discuss the Commission at length today, but do reiterate our recommendation that greater clarity is needed on the role of the Commission and how it works in practice, particularly regarding whether it is asked to agree the forecasting methodology prior to publication of the official forecasts and what happens if it does not. Regarding the Scottish Futures Trust, we invited written evidence on how successful it is in achieving its stated aim to improve the efficiency and effectiveness of infrastructure investment and use in Scotland by working collaboratively with public bodies and industry, leading to better value for money and improved public services. The overwhelming majority of responses were positive and indicated a high level of regard for the SFT, its staff, their professionalism and collaborative approach. Suggestions on how the SFT could further improve its work were also made, and we look forward to hearing the SFT's views on these in due course. Staying with capital investment, an issue around which ongoing concerns have been raised relates to the impact of the European System of Accounts 2010 regulations, which have led to certain non-profit distribution projects being reclassified as public sector spending. We note that £398 million was allocated from the Capital Departmental Expenditure Limit budget in 2016-17 to cover NPD projects, and believe it vital that full transparency is provided on the impact of reclassification, particularly where it resulted in delays to other planned capital investment projects. This is no doubt relevant to those fiscal framework negotiations relating to additional borrowing powers, and we would welcome an update from the Deputy First Minister. The committee continues to scrutinise the Government's commitment to a decisive shift towards prevention, a subject in which we have long taken an interest. Whilst there is evidence of progress, the committee remains frustrated by the lack of evidence of any large-scale shift towards prevention. We received over 40 responses to our call for evidence on the topic, with several highlighting perceived barriers, including a lack of shared ownership among public sector partners. It is clear that if the decisive shift towards prevention does not take place, public bodies will face growing demands for services against a backdrop of finite and possibly diminishing resources. The committee therefore agreed to take further evidence on prevention before reporting our conclusions by the end of this session. Presiding Officer, I said at the beginning that the committee's budget scrutiny focused on affordability and budget processes. Many other topics were also covered in our report, and I am sure other members will raise these later in the debate. I hope to have given a flavour of the increasingly broad range of subjects considered by the Finance Committee as part of our draft budget scrutiny, and I look forward to hearing from other members.
Thank you very much. And to now call Murdo Fraser.